Welcome to this week's Money Metals podcast, helping gold and silver investors during these turbulent times. Now, here's this week's market wrap with commentary and analysis from the low-cost precious metals dealer voted best in the U.S., Money Metals Exchange.
Welcome to this week's Market Wrap podcast. I'm Mike Leeson. As trading kicks off the month of October, many investors are looking for a place to hide. The U.S. stock market got slammed on Thursday to finish out the month and the quarter on a down note. The S&P 500 fell 5% overall in September. Bonds also fared poorly last month as yields rose. As for precious metals markets, they too lost ground. However, gold and silver prices did manage to rally yesterday and today. Although it's too early to read much into the move, bulls can take some encouragement from the fact that metals markets diverged positively from the stock market. Perhaps something of a fear trade is beginning to materialize heading into the fourth quarter. With all the debt drama in Washington, all the imbalances in the economy, and all the market distortions created by the Federal Reserve's inflationary monetary policies, investors face considerable risks in conventional financial assets. There's no value to be found in the bond market, with yields still well below inflation, and stocks may have much further to fall before they become bargains on a valuation basis. Gold and silver are looking attractive to value-seeking bargain hunters. Gold prices currently come in at $1,764 per ounce, up 0.5% since last Friday's close. Silver is now up a slight 0.3% this week to trade at $22.57 an ounce. Platinum shows a weekly loss of 1% to trade at $985. And finally, palladium prices are clinging to $1,945 an ounce after falling 3.1% on the week. Metals markets aren't currently reflecting the price inflation that is hitting other sectors of the economy, but that can change as quickly as shifts in investor sentiment. Optimism toward the economic recovery in the stock market has put a damper on gold and silver as an investment theme, but inflation is starting to hurt a lot of companies, not to mention individual consumers, savers, and retirees. In testimony before the Senate Banking Committee this week, Federal Reserve Chairman Jerome Powell acknowledged that inflation isn't turning out to be as transitory as he had expected. He said that, quote, inflation is elevated and will likely remain so in the coming months before moderating, end quote. Even if it moderates at some point in the future, it won't reverse. The damage has already been done. Higher prices are here to stay. One sign of the times is that dollar-side menus at fast food restaurants have been trimmed, eliminated, or converted into $2 and $3 menus. Meanwhile, dollar stores are facing an identity crisis as their brand becomes economically unviable. Dollar Tree operates under the trademark slogan, "Everything's $1," but it is now introducing products priced above $1, as Brian Suzioff of Yahoo Finance reports.
Social media uproar over Dollar Tree. They came out this week saying they're going to start selling more products over $1. They've already been testing this at hundreds of stores, most notably in early August, just as a way to offset inflation, ultimately appease an activist investor that showed up on their doorsteps last year here. They cannot continue to sell a whole store full of stuff for $1 when you have inflation in transportation and workers going through the roof. Realistically, over time, Julie, it will probably be a $10 tree store.
Any business that pegs its pricing structure to a set quantity of U.S. dollars is operating an unsustained model. Just like the old 5 and dime stores have gone by the wayside, so too will the availability of products priced at just $1. At the root of the inflation problem afflicting businesses and individuals is the excess creation of fiat dollars by the central bank. The Fed is digitally printing currency units by the trillions in large part to prop up the U.S. Treasury market and enable Congress to run multi-trillion-dollar deficits. Over the past 18 months, the Fed has purchased 57% of all new Treasury issuance. Fed policymakers are taking the U.S. down a dangerous road toward total debt monetization. The biggest risk of such a policy is an untamable rise in inflation as Uncle Sam's need for cash grows faster than the economy's ability to generate it. And the biggest risk for investors is holding too much of their wealth in dollar-denominated financial assets. A supposedly well-diversified portfolio of stocks and bonds can perform terribly during periods of stagflation, and stagflationary periods such as we experienced in the late 1970s can drag on for years. In such an environment, hard assets are the place to be, and the best time to buy them is when they are on sale. Well, that will do it for this week. Be sure to check back next Friday for our next weekly Market Wrap podcast. Until then, this has been Mike Leeson with Money Metals Exchange. Thanks for listening, and have a great weekend, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes for answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds. Call 1-800-800-1865 or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by between 7 a.m. and 5:30 p.m. Mountain Time, Monday through Friday. Or you can lock in your order online, 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.